Good morning. Today we will discuss features of foreign exchange market. Here we will be discussing about how the foreign exchange market operate, who are the participants in the foreign exchange market, and how the foreign exchange market over different countries have developed, and foreign exchange market, how the foreign exchange quotation take place, how the participant take position in the foreign exchange market, where different exchange rate are there for different requirements. In this process, we will conclude that foreign exchange market is highly liquid, foreign exchange market turnover is very high, foreign exchange market the market participants are very large, and individual players in the foreign exchange market cannot create any kind of pressure in determining the market exchange rate. Let us start with the foreign exchange market features. The focal points of understanding international finance revolves around foreign exchange market. If you want to understand the international finance, you have to understand the foreign exchange market. In foreign exchange market, international currencies are traded. Different countries have their own exchange rate, their own foreign currency. As we discussed in the earlier session, now almost all countries are under inconvertible paper currency standard. The domestic currency are in papers, and these papers are traded in international market in the form of foreign currency. So, in foreign exchange market, international currencies are traded. On the basis of buying and selling, the exchange rate among countries determined. It is a market where banks, companies, exporters, importers, fund managers, individual, central bank of different countries buy and sell foreign currency. So, this foreign exchange market, the participants are number of participants are there. The commercial banks, they are authorized dealer in foreign exchange market, corporate they buy and sell foreign exchange, exporter, importers, fund managers, individuals, central banks all participate in the foreign exchange market, and their demand and buying powers determine the exchange rate. Foreign exchange markets are quoted in pairs of currency. Example, euro against dollar, US dollar against Japanese yen, US dollar against Indian currency, that is INR. Each currency has a symbols. The symbols are internationally determined, and there are international standardization process is there to get a symbol for domestic currency. So, in foreign exchange markets, the exchange rate take place among two pairs of currency. The pairs of currency among each other determine the exchange rate, is called cross currency exchange rate. So, who are the participants in the foreign exchange market? The forex market is a OTC market. It means that over the counter the trading take place. There is no physical place where the foreign exchange buyers or sellers meet together. It is a OTC, over the counter, where telephone or internet facility, other communication networks help in trading process. So, foreign exchange market is a OTC market without any centralized clearing house. Centralized clearing house may not be there, but there are some agency, some platforms provide the central clearing process, but there is no physical place where foreign exchange of different currency are traded. Foreign currency transactions are channeled through worldwide interbank market. The banks in different countries, they themselves create an interbank market. Through the interbank market worldwide, the currency are channelized. Then who are the participants in the foreign exchange market? The participants are banks and non-bank foreign exchange dealers. Bank, commercial bank, non-bank, the insurance company, the mutual fund, provident fund, the non-banking financial intermediaries are there. They are the primary purchaser or seller of foreign currency. Foreign exchange brokers are there. Broker, they get the quote and try to maximize their return. hedgers, speculator, arbitragers. They are also participants of the foreign exchange market. Hedgers, importer, exporter, they have underlying risks in foreign exchange. So, they hedge their position. Speculator, because one currency the rate the speculator take profit from the market when there is a movement of a foreign currency, volatility of foreign currencies are there, they take position in the foreign exchange market and try to make profit. A arbitrager, they change their position from one country to another country, from one currency to another currency and take arbitrage opportunity available in different currency. Central bank and treasury, central banks generally intervene in the foreign exchange market so as to target a particular exchange rate, because each country has own target its own currency rate, because currency, as we discussed earlier, currency rate decide what is called the macroeconomic policy of a country. So, always central bank try to intervene in the foreign currency market so as to target particular exchange rate. The exchange rate should not be volatile in nature, it should not affect the export importer, and because of that reason always central bank try to intervene in the foreign exchange market. Individuals and firms conducting commercial or investment transaction. If an individual they need foreign exchange, firms also they need foreign exchange, they also participate in the foreign exchange market. Market participant further, the wholesale forex market, and also we have a retail foreign exchange market. Wholesale foreign exchange market primarily banks and non-bank, they are the major player in the wholesale foreign exchange market. They undertake trading on the again for their own customers. They buy and sell foreign exchange to take profit, and also they act as a broker, as an agent for exporter importer, and because of that reason they are the wholesale player in the foreign exchange market. Similarly, other institutions also play, they are the hedge fund, pension fund, provident fund, insurance company, mutual fund, they also trade in wholesale market in foreign exchange. Hedge funds collect huge sum from high net worth individual and undertake what is called speculative trade in equity, debt and forex derivatives. Mutual fund also take position in international equity market. So, they are also the market participant in foreign exchange market. So, there are, if you see in a larger perspective, in foreign exchange market we have three different players, major players, they are hedger, speculator and arbitrager. Hedger are trader like exporter, importers who undertake forex trading because they have assets or liability in foreign currency which value continuously changing. Hedgers use the foreign currency market to hedge risks associated with the volatility in foreign exchange market. Speculators are traders who essentially buy and sell foreign currency to make profit. These traders do not have any genuine requirement for trading foreign currency, because there is no genuine requirement speculators. Speculators change their position to make profit, their position they change from one currency to another currency, from one country to another country. Wherever there is a profit, they take the profit. They buy and sell foreign currency for very few minutes, and within the few minutes they make profit and take away the profit and go out from the liquidate their position. Arbitrager buy and sell the same currency at two different places, and whenever there is a price discrepancy, because it may happen that when US dollar against India or Indian currency and US dollar against Japanese yen and yen against India, there is a three-way arbitrage possibilities are there, because there may be some minute level of profit arise within the market, and this minute level profit arbitrager take booked and move from one place to another place, from one market to another market. So, there are other players in the foreign exchange market also. The players are central bank, treasury and retail. Central banks and treasury, as I mentioned earlier, all central bank participate in foreign exchange market to maintain a official or unofficial target exchange rate for against their home currency. Because it is generally found that all central bank try to target a particular exchange rate which is suitable for their economic policy. Whenever there is a volatility, speculation, whenever there is a appreciation, significant appreciation, depreciation in foreign currency, the central bank intervene in the foreign exchange market by through buying and selling of foreign currency asset or foreign currency itself. Treasury of commercial bank they generally trade in foreign exchange market not only to make profit, but also for their own customers. The customers are primarily broker, dealers, arbitrator in foreign exchange market. They take the customers may be exporter, importer, some kind of big net worth individual. For them the commercial bank take position in the market. Each generally commercial bank has a foreign exchange dealing rooms or treasury. The treasury they take position in the foreign exchange market for their own customer, also to make profit. Retail market, in foreign exchange market, retail markets, retail individuals, the individuals may be in the form of they need foreign exchange for tourist purpose, for student also need foreign exchange, patient traveling to other country they need foreign exchange, and small company, small exporter, importer they need foreign exchange for their export import side. So, retail market primarily small transaction take place, where individual or small company they trade in retail market. There are money transfer companies are there, remittances companies are there. So, they also like traveling agencies are there, tourist companies are there, they also like our Western Union, Thomas Cook, these are agency also small transfer of foreign currency for remittances purpose, they also participate in the foreign exchange market. They are the retail player because the volume transaction is very low here. So, as per after discussing about the participant in the foreign exchange market, let us come to about Forex settlement and SWIFT. As I mentioned that foreign exchange market there is over the counter and it take place through the what is called a commit, that is through a telecommunication networks. Through the telecommunication networks the foreign exchange trading takes place, settlement takes place, and worldwide there is an agency called SWIFT. It is a cooperative agency among and interbank companies are participant in the SWIFT account. All transaction settlement take place through SWIFT account. In an interbank forex, all transactions are done electronically through SWIFT. SWIFT stands for Society for Worldwide Interbank Financial Telecommunication. It is a cooperative agency organization having its headquarters in Belgium. All foreign exchange dealers they are the member of the SWIFT. At present maybe around more than 8,000 banks, financial institutions and company operate are the member of SWIFT. They are operating the SWIFT spread over to more than 200 countries, and SWIFT all members are dealer they have accounts in a SWIFT, and whenever there is a transaction take place the transaction pass through a SWIFT network in the form of a telegraphic message, and that message determine whether the particular bank or authorized dealer is buying or selling foreign currency, and automatically the transaction settlement take place. There is no physical movement of currency from one place to another place, and SWIFT provides the platform for remittances, for trading, for channelization of foreign exchange, for the settlement purpose. SWIFT there are many other worldwide platforms are there, and SWIFT is the largest platform in the country in the world at present, providing settlement for the international transaction process. The question is where the markets are. We discuss about foreign exchange market, but is there any market for foreign exchange? There is no physical place. I mentioned there is no physical place for foreign exchange market. It is a over the counter market, and the settlement trading take place through through a through a telecommunication network, primarily over telephone, over SWIFT account. Forex market is a 24 hours market, 365 days market. Round the year the market operate, round the clock the market operate. As the market remain open in different time period, different time on a given day, normally GMT, the Greenwich Mean Time, is used to refer what is called trading hours at different location. The contacts are all over the globe, because the foreign exchange market 24-hour market is all over the globe, the transaction take place, and the 24-hour 5 days market operate around the year 365 days. Day opens at Tokyo, early morning it starts from Tokyo and Sydney, and day closes at Los Angeles, and in between it passes through different countries different time. Before closing at Los Angeles, Sydney again opens for the next day. So, it is a 24 hours market. If you see the pattern, the 24-hour market is Sydney and Tokyo almost same time start, then it pass through around 6:30 or 7 o'clock of Indian IST, Indian Standard Time at Hong Kong, Singapore. Around 9 o'clock it is early mornings of 9 Mumbai, Bahrain. Then it same time around 6 of evening of Indian Standard Time, the Frankfurt, Zurich, London operate. Then it passed through New York, Los Angeles. When about Los Angeles market about to close, Sydney and Tokyo market that time about to open. So, it is a 24-hour market, and foreign currency trading take place all over the world at any times. So, whenever some companies or some individual have foreign currency assets and liability, the assets and liabilities change their value, because trading taking place every moment in foreign currency market. So, when trading taking place every moment in foreign currency market, even though we are closing our balance sheet, the balance sheet never close, because the foreign currency value either appreciate or depreciate as per the trading. So, foreign currency market is a highly liquid market. Liquid market in the sense that continuous buying and selling, 24 hours or buying and selling take place in foreign exchange market. There are number of players in the foreign exchange market. A liquidity is reflected by a number of players. There are market makers, market takers are there, and traders in foreign currency markets are huge. Large commercial bank, central bank, the currency speculator, currency arbitrager, corporate, government, financial institution, exporter, importer, they take part in foreign exchange market. It is a huge market, huge volume of transaction, and having high liquid market, because the particular day the trading itself is trillions of dollars. So, the liquidity in foreign currency market is the highest. There is no such market in the world as liquid as the foreign exchange market. So, foreign exchange market, there is no one single rate. The different rates are there for different kind of traders. We have a spot rate, spot rate market relate to immediate purchase and sale of foreign currency market. So, spot market is where the immediate transaction take place. There is outright forward market, because when somebody needs foreign exchange after 1 month, 2 months or 10 days, there is a market for them also, which is called forward market. There is swap market, because want to convert one currency to another currency, one party, there is a negotiation among the different party agree to swap their currency, that is a swap market. Also, nowadays foreign currency derivative markets are there, where futures options are traded in recognized exchange. The foreign currency derivative market also quite popular nowadays. So, for different purpose different rates are there. Along with that, we have interbank rate, we have merchant rate, we have rate for small transaction, large volume transaction, that also part of the different rate. So, what are the instruments in foreign currency market? The foreign exchange market have different kind of instrument. It instruments spread over from 2 days to 10 years, 15 years. The instruments have different own places of trading. The places are like London, New York, Tokyo, the Hong Kong in India, in Asian region, Hong Kong, Singapore, the major places where foreign currency trading take place. There are different kind of instrument for trading foreign currency market. These are called commercial papers, banks borrowing, banks acceptance. These are different instruments, short term transaction. For long term transaction, we have equity market, we have the instruments are also there for JDR, global deposit receipt, American deposit receipt, long term offshore market, long term borrowing markets are there where foreign currency instruments are available. The clearing houses, as I mentioned, there are number of clearing houses. The chief chaps, these two clearing houses, they are primarily centered around US and European country, and SWIFT is the worldwide trading platform for settlement of foreign exchange transaction. There are generally two concepts are there in foreign currency market, which is called generally we divide the participant into market maker and market taker. Market makers and market takers, they are the participant in the foreign exchange market. Market maker generally influence the command the foreign exchange market. Market taker accept the price determined by the market forces. Since large number of participants are there, large volume transaction take place, it is very difficult to decide in a particular time period who is the market maker, who is the market taker. It may happen particular moment the market makers, some banks may be market maker, next moment they would be market taker, depends upon their volume of transaction, their requirements. When they have huge amount of foreign currency, they want to upload in the foreign exchange market, generally they are the market makers. Whenever there is a requirements are there, they want to buy from the foreign exchange market, they are the market takers. So, market makers and market takers change their position as per the requirement, and not a single player can command over the foreign exchange market, because players are huge, volumes are large, it is almost a perfect competitive market. Exchange, let us now come to the exchange rate mechanism, because foreign exchange market is a different market where exchange rate depends upon the different kind of quotation. We call exchange rate quotation, there are direct method, indirect method of quotation. When you mention US dollar, one US dollar is 53.4525 and 45.50. What does it mean? It means that when you write the 1 US dollar is equal to rupees 53.4525 oblique 45.50. It means that when I have US dollar, I want to sell in the market, then market will give me rupees 53.4525. If you want to buy US dollar from the market, I have to surrender Indian rupee 53.4550. So, this is called direct method of quotation of foreign currency market. Here you are quoting if 1 US dollar how many rupees, and if I buy 1 US dollar, then I have to surrender more Indian rupee. You want to sell US dollar, the market will give me less. So, when I want to purchase US dollar from the market, I have to pay 53.4550. Want to sell US dollar in the Indian, then market will give me 53.4525. So, the difference between it is called offer rate and bid rate. The offer rate and bid rate the difference between these two generally contains the transaction cost and the profit for the brokers, because authorized dealer I have to purchase foreign currency from the authorized dealer, I have to sell foreign currency with the authorized dealer. So, authorized dealer always try get a commission which is nothing but the difference between offer price and bid price. The offer price and bid price contain the transaction cost and profit for the authorized dealer. So, what I mentioned here, the offer rate and bid rate determine the transaction cost and profit. Here bid rate, bank would purchase at 45.25. We have US dollar, bank will purchase, bid for the US dollar are the 45.25. If you want to buy from the bank, banks are authorized dealer. You want to buy US dollar from the bank, bank will offer US dollar or 45.50. So, this is called the bid rate, and this is called offer rate. Then offer rate and bid rate decide what is called transaction cost plus profit for the authorized dealer. So, always in foreign currency market two-way quotation take place. The two-way quotation, that whenever you want to purchase US dollar or want to sell US dollar, you have to go to authorized dealer. Authorized dealer in India are all financial institutions, that is commercial banks are there. When you want to purchase dollar, you have to go to a bank and ask for a quotation. The bank will give the bank will ask you whether you want to buy or sell. If you do not disclose your position, they will give you a two rate quotation, what is called, what is the buying rate, what is the selling rate. They will never give you one way quotation, because two way quotation is they do not want to disclose whether the authorized dealer want to buy or sell, because if they disclose their position, then there will be rigging in the foreign exchange market. So, for that reason always two way quotations are there in foreign exchange market. Authorized dealer never disclose whether they are buyer and seller. When you go to a bank and ask for the quotation for the dollar, they will give you the 43, 20, 40, 45, 25 or 45, 50. These are buying rate and selling rate of US dollar against Indian rupee. Then as I mentioned, there is a direct and indirect quotations are there. Direct quotation is home currency, in direct quotation home currency vary, foreign currency remain constant. So, when you mention here $1 is 53, 45, 25, 45, 50, it is a direct quotation. Here the Indian rupee is varying, US dollar is fixed, Indian rupee is varying, US dollar is fixed here. So, it is a direct quotation. In case of indirect quotation, the home currency, that is in case of India home currency rupee remain constant, 1 rupee how many dollars. So, that is indirect quotation. So, suppose we have a indirect quotation, then 1 rupee is equivalent to 0.01874 US dollar, that is per rupee you will get this much of dollar, this many of dollar. So, it is a indirect quotation. In India, at present we have direct quotation, many countries also following direct quotation, indirect quotation you rarely find. So, in case of India we have direct quotation, our home currency is varying and foreign currency is fixed. So, it is a direct quotation. The exchange rate mechanism, as I mentioned here, exchange rate quotation, we have different kind of rates in foreign exchange market, different markets, because in India we have interbank market at Bombay. Similarly, interbank market also available, in London, Tokyo, Singapore, Hong Kong, many other places. So, suppose there is a interbank quotation rate here. interbank market at Bombay quote US dollar 53.45.25. So, US dollar interbank market quote in Bombay 1 US dollar is 53.45.25 and interbank market in London quote 1 US dollar in place in terms of French franc, French currency is FRF 6.75007550. Then how we can exchange FRF against Indian rupee? Because here you have Indian rupee, you want to purchase French franc. Then question is here how you can purchase? You have to go from one market to another market, because there may not be a direct quote for French franc available in Indian market. What you have to do? You have to purchase dollar from India, then sell the dollar in London to get the French franc. When you want to purchase dollar in India, then you are surrendering rupee, purchasing dollar, the authorized dealer will ask you here US dollar 1 US dollar is equal to 53.45.25 and 45.50. So, in London Indian market, Bombay market US dollar is this is a Bombay market, Bombay interbank market. So, US dollar is available at 53.45.25, 45.50 means want to purchase US dollar, you have to surrender more. Then buying rate of US dollar will be 53.45.50. Once you surrender rupees 53.45.50, get 1 US dollar. Then in the London market you sell US dollar and purchase franc. So, in London market US dollar is US dollar 1 US dollar is FRF 6.7500 and 7550. Since you are selling US dollar, you will get you are selling US dollar in London market. So, you will get less amount. So, you will get for 1 US dollar you will get French franc of 6.7500. So, 1 US dollar is 6.7500 and 1 US dollar in Indian rupee is this 2. So, it means that 53 rupees 45.50 is equivalent to FRF 6.7500. Now, you can calculate 1 FRF is how much, how many rupee. So, FRF we can calculate FRF 1 is equal to how much rupee by dividing these 2. So, this will give you the Indian rupee. The conversion of these 2 will give you the 1 FRF is how many rupee. So, this is called cross currency calculation process, because in many market you cannot get a direct quote for your own domestic currency. So, if you want to purchase in India French franc, then you have to migrate from interbank market Bombay to interbank market London to get a indirect quote for the FRF against Indian rupee. So, there are different rates in the market, because foreign exchange market is highly volatile market. The rates are changing continuously. In a particular moment you can get 10-15 quotation for US dollar in India itself. So, different banks or different authorized dealer will give you different rate for US dollar at a particular moment. So, where different rates are available? If you see rates are given by different bank a particular moment. Syndicate bank in India giving 1 US dollar 53.34.35. Here Canara Bank is giving 53.33.50, 34.50. Nova Scotia small banks of foreign bank is giving 53.34.25, 35.25. A particular moment different authorized dealer is giving different quote for US dollar in against Indian rupee. Why it is happening? Because the quotes are perceived by the market. What market players, in the market different players are there, their psychology, their behavior, their perception decide the rate, and different market players in particular moment give different rate for the foreign currency. So, the different rates are available why? Because the different rates are available because position, need and view. Position, some authorized dealer might have large amount of dollar, they want to take a dollar position, they give you high quote for dollar. Some need dollar, they give you low quote for dollar. Some authorized dealer may view the market, dollar will appreciate, so they will give you high figure for the dollar. So, the views, need and position decide the rate, and also for different players, if you are a exporter, you will get a good quote for your dollar, because large volume transactions are there. If you are individual buyer, you will get a large quote for your dollar because your volume is very less. So, business interest, market players, for business interest, market makers always quote prevailing market rate. So, market player decide what kind of rate they supposed to give to different players or different participants in the market. Then question is here, why different rates are there in foreign exchange market, and which are the factor which affecting the foreign exchange market. So, the factors are balance of payment, because in the balance of payment if you see export, import, foreign current account payment and receipts are there. Exporter export their commodity and get foreign exchange. Whenever large amount of foreign exchange are there, they will appreciate the domestic currency. Importer generally require foreign currency to buy foreign asset or some kind of goods and services from foreign country. When importer demand more foreign currency, then rupee or the domestic currency will depreciate. Similarly, if there is a large foreign current account deficit, the current account deficit is primarily because of export import. If the imports are more and more current account deficits are there, then domestic currency will depreciate. Similarly, fiscal taxation, interest rates are there, also influence the foreign exchange market. Money supply create inflation. So, inflation also depreciate the domestic currency. Central bank intervention. Central bank, as we discussed earlier, central bank always interfere in the foreign exchange market to target a particular exchange rate which is suitable for their exporter importer for their economic activity. So, their intervention also influence the foreign exchange rate. Speculator always buy and sell foreign exchange to get the foreign currency for to get profit, and their position also influence the foreign exchange rate. And most important, the expectation of and traders behavior, because if traders behave, particular currency may appreciate, so they take position in the currency. A trader's behavior or their expectation also influence the foreign exchange rate. These are the basic parameters which are some real sector, some are the monetary sector that influence the exchange rate in a country. Exchange rate settlement mechanism, because in exchange rate market 3 different kind of settlement take place, particularly at spot transaction rarely settlement take place, all transaction cash transaction, term transaction and spot transaction, these are the what is called very short term transaction in the foreign exchange market, and this transaction influenced by everyday movement of foreign currency. Cash transaction take place same day, today purchase same day, today itself you close your position. Term transaction next day means you are purchasing something for tomorrow, today you purchase, tomorrow you liquidate your position. That spot transaction, spot is after 2 days, 2 days means today you purchase, tomorrow and day after tomorrow you settle your position, that is called spot transaction. And there is also transaction forward transaction, what is called beyond 2 days, and this is a forward transaction. After 2 days you need foreign currency, you go to the authorized dealer, ask for a quotation, what is called forward transaction. Forward transactions are available beyond spot rate, that is beyond the 2 days, and is available in India for up to 9 months to 1 year. So, forward transaction generally a hedgers, exporter, importer, they take in forward market to remove the risks in the foreign exchange transaction process. So, forward transaction is a risk management product. So, there are different markets rates are there, what is called interbank forex rate. We have a merchant rate, we have interbank rate. Interbank forex market primarily for banks and financial institutions. Authorized dealers are the member of the interbank market, they transact among themselves. So, that is the interbank rate. It is a wholesale market, because wholesale player, that is a player, large volume transaction players, the interbanks are the wholesale market, and there is a minimum lot size for interbank also, that volume is fixed, minimum lot size are there. So, volume is something very big. Banks contact each other over phone, over phone or over internet facility available nowadays, and try to get the buy and sell foreign exchange. Generally few market makers and many market takers would be there, because in internal market very difficult to influence the rate. So, market makers are very few, because very big bank like in India, State Bank of India, one of the largest player, or ICICI Bank, one of the largest player, HSBC the largest player, Citigroup the largest player, they might be the market maker. All other authorized dealers, small banks are there, merchants are there, they are market takers. Market makers can sell buy according to the request. Then whenever there is a request from the customer side, the market makers buy and sell foreign currency. Banks contact market maker over phone or trading screen. Now, the Reuters screens are there, Bloombergs are there, they also buy and sell take place through the trading screen, and also maximum buy and sell take place through over the counter, that is through telephone lines. So, interbank rate one of the lowest rate in the market, because large volume transaction take place, players are very few players are there, transaction take place for the requirements only. Interbank is the most liquid market, and therefore, the benchmark, it is the benchmark rate for other rates, because other rates are there, spot rate, forward rate, merchant rate are there in foreign currency market. Interbank rate, it is the benchmark rate against which the other rates start. Similarly, interbank spreads are very less, so spreads may not be available. Interbank rates form the basis on which other rates depend, other rates are quoted also. Interbank rates are also called base rate. The base rate, because a benchmark rate, for that reason called the base rate. Other rate nothing but a margin over the interbank rate. There are also some rate called merchant rates. Merchant rates are two types, because merchants are exporter, importers, they are the merchant, their volume of transaction is very high, they need foreign currency for buying, for importer needs for buy goods and services, exporter gets foreign currency by exporting the goods and services. So, whenever the merchant rate, so for exporter importer primarily. So, there are two kinds of rates available as a merchant rate, one is called TT rates, telegraphic transfer rate, and bills rate, because all export import contract are on bills basis. So, bills rates are there, TT rate, telegraphic transfer rate, bills rate called, and there are different kinds of merchant rate, one is called buying rate, another is called selling rate. For buying rate, TT buying rates, telegraphic transfer buying rate, TT selling rate, that is called bills buying rate. Whenever a merchant, the merchant can buy rates or sales a rate. Similarly, selling side, TT selling rate and bills selling rate. We have TT buying rate, bills buying rate, we have TT selling rate and bills selling rate. So, on this rate, the TT buying, TT selling, bills buying, bills selling, all merchant transaction take place, and we will be discussing, we will be using this rate for further calculation when we will discuss the arithmetic of exchange rate. We will use this rate for the calculation of LC, guarantee, other things. So, bills buying, bills selling, TT buying, TT selling, the basic rates for the margin transaction. So, in the TT rates applicable to TT buying rate for inward remittances, for TT telegraphic transfer, money transfer, there is demand draft in foreign currency, the TT buying rates are available. Conversion of proceed of instrument, when the exporter brings foreign currency, they convert the foreign currency against TT buying rate. When cancellation of outward transaction, suppose importer wanted to cancel the contract, import contract, they use the TT buying rate. TT selling rate outward remittances, suppose you want to remit from currency US dollar from India to abroad, you purchase a TT, you sell a TT, what is called TT selling rate. The outward transmissions are there. Similarly, purchase of foreign currency, telegraphic transfer, money transfer, in case of foreign currency transfers are there you TT selling rate. Conversion of proceeds instrument also for usage, cancellation import document received directly by the importer, all the TT selling rate you use, and you will be using this rate for different calculation in our next class. Bills rate applicability, bills buying rate, purchase discount and negotiation of export bill. Similarly, bills selling rate, transaction involved for remittances of import bill. So, bills buying, bills selling, these are contract instruments. The contract instruments are used for bills rate, and these applicable rates are bills buying rate and bills selling rate. There are another transaction rates are available in the foreign currency market, which call it forward contract, because in forward contract, as I mentioned earlier, it is a risk management practices. The all foreign currency transaction forward beyond 2 days take place at forward rate. Because suppose a importer needs dollar after 10 days, rupee is depreciating, then dollar will appreciate. So, there is a risk for the importer. So, importer want to minimize this risk, he will book the dollar from now onwards. So, that how to book, there is a forward transaction take place against US dollar. The forward rate comes. Forward contract are risk management practices, risk management instrument available in foreign currency market. There are two party A, the one party sells the forward contract, another party purchase the forward contract. Parties agree to buy and sell specified amount of foreign currency after specified date in near future. So, there is no immediate transaction, may not take place anything. The transaction take place after the forward during the time of delivery of the forward contract. So, at the delivery time, the contract may be cancelled, contract may be physically delivered, or there may be cancel, cash settlement may also take place. Forward contract are risk management tools available in foreign currency market. Forward contract are over the counter rate, OTC market rate. Let us come to the conclusion side of the foreign exchange market. We discussed various features of the foreign exchange market. The features are, foreign exchange market is highly liquid market, it is a market for 24 hours. So, every moment you can get a quote for the foreign exchange rate, foreign currency rate. Large numbers of buyers and sellers are there in the foreign exchange market. Hence, individual buyers and sellers may not be in a position to influence the foreign exchange market. However, it is possible that particular moment some players may be market maker and some players may be market taker. However, it is not possible for particular player to be market maker always or market takers always. The market makers and market taker depends upon the strength of foreign currency market and also their individual strength during the time of buying and selling. Different rates are available for different purpose in foreign exchange market. There is spot rate, cash rate, term rate, forward rate, merchant rate, interbank rate. These are the different rates are available for different purpose, for different transaction, for different instruments of foreign exchange market. Foreign exchange market primarily OTC market, over the counter, through internet, through telephone. Recognized foreign exchange trading places are there, recognized exchange are there, where the foreign exchange derivatives are transaction take place, that is called derivative in foreign exchange market. Then options futures are take place, transaction take place in a recognized stock exchange. However, The primarily foreign exchange market, spot and forward market, their rates are over the counter and settlement take place also through over the counter. And SWIFT, Society for Worldwide International Financial Transaction, that is a platform, is a platform among the banks, that SWIFT provide the platform for settlement of remittances, settlement of foreign exchange dealings, foreign exchange transaction process, which is a worldwide body. All banks and financial institutions, authorized dealers are member of foreign exchange market and they have the SWIFT account. We have domestic international factors that derive exchange rate. There are many factors which derive the exchange rate, which domestic factor, international factors are there. We also discuss about the same thing. Interbank and merchant rate are primary, merchant are the primary players in foreign exchange market. So, interbanks are authorized dealer, merchant exporter, importer, they are the primary players in foreign exchange market. We have major currencies in foreign exchange market at present, the US dollar, euro, Japanese yen, French franc, these are the major currency in foreign exchange market. At present, major places are London, New York, Tokyo, Hong Kong, Singapore, these are the major places for foreign exchange trading process. After discussing these foreign exchange features of foreign exchange market, next session we will be discussing about the arithmetic of foreign exchange calculation process. There we will discuss about the different rates calculation and you will be using the forward rate, TT buying, TT selling, bills buying, bills selling, direct quote, indirect quote, all these concept and calculate the exchange rate. References are given here, these are references are there, these references are useful for you, you go through the reference and you can learn further. Model question, I will mention here model question, some questions I identify. Why forex dealers give two-way quote in terms of bid and ask? What is the requirement of two-way quotes? You will discuss, because buyers and seller, the authorized dealers, they do not want to disclose themselves whether they are buying and selling. If they disclose that the buying, they are the buyer, they are the seller, they are the rigging, there will be artificial appreciation, depreciation of foreign exchange. So, two-way quote is essential for the functions of foreign exchange market. What is the difference among hedgers? Differentiate between the hedger, speculator and arbitrator. Why they are different? And what are the functions of hedger, speculator and arbitrator? You discuss the functions of hedger, the functions of speculator and such functions of arbitrator, why they are there in the foreign exchange market, what way they influence the foreign exchange rate. This we have to discuss in the second question. Third question, explain the rule of SWIFT in forex trading. The SWIFT, as I mentioned, is a platform for the foreign exchange transaction process. How the SWIFT provide the platform, what way the transaction take place, what way the settlement take place. You discuss all these things in the third question. Fourth is the describe various factor affecting foreign exchange rate. Here we will discuss what are the factors, that is a balance of payment, fiscal policy, monetary policy, inflation, exchange rate, money supply, expectation, behaviors of customer, behaviors of trader, all these factors affect the foreign exchange rates. You have to discuss in the question number 4. Thank you.